Thanks a lot, Roland, for the introduction. And good afternoon, everyone. Thank you for dialing in today and most importantly, still staying with us. I am pleased to join the conversation today representing Fidelity International and the Fidelity European Trust. I'm going to speak about equities markets with a focus on the continental European geography. Passing through some housekeeping here. I will let you read that at your leisure. In the meantime, let's set the scene a little bit and have a quick recap of where we are today in terms of sentiment and equity markets. There seems to be an almost universal consensus that 2020 will be a year of strong economic recovery. Mr. Market seems to have decided that the pandemic is now merely a lingering disruption that will dwindle as vaccination programs are rolled out. There is also an expectation that the ongoing economic recovery will be boosted by fiscal policy, a case in point being Biden's $1.9 trillion plan passing through, and the stocks to be just boosted by abundant liquidity with central banks globally vowing to keep monetary policy and easy and interest rates very low until employment recovers. So on this optimistic mood, there is an implication that the recovery in earnings and dividends in 2021 is going to be significant. Analysts are forecasting 30% plus increase in Europe ex-UK, for example. If I may move to the next slide. As a consequence of this optimism in the market, what we have seen at the end of last year as well as year to date, we have witnessed a strong reversal in momentum and the types of companies that investors in the market is preferring. We have a so-called economy reopening place recovering strongly, while many of the winners of the first 9 months of 2020 lagging really badly. And the type of companies or sectors that European equity investors as well as even global investors have favored are more cyclical areas of the market, like the energies, the financials, the materials. Smaller caps are being preferred over larger caps and value over growth. Areas that are deemed to be direct beneficiaries of a more reflationary environment. And the market seems to be expecting that valuations will hold up in aggregate. We are, however, concerned that sentiment has become very stretched, with many of you having heard, with IPOs flying, retail investors buying more actively, directly into stocks, with riskier assets breaking all-time highs like Bitcoin. Even the discount on the European trust has narrowed significantly versus historic levels. However, for growth strategies like ourselves and many of the investment teams that have presented today, it has been a challenging environment as we tend to favor more defensive growth style stocks per general. So let's talk about the elephant in the room that some of the previous presenters have alluded to as well, which, does that mean that the economic recovery, as it accelerates, inflation is showing signs of picking up? In some parts of the market, we have started seeing that with food price inflation, commodity and raw material prices in particular. As we are speaking to the companies that we invest in, we really start seeing raw materials as a big issue. So the interest rates as a consequence should start going up, and we should see central banks changing their policy. We would, however, caution on considering first and foremost the difference between inflation expectations and when inflation actually is coming through. The knee-jerk reaction when inflation expectations rise is for value sectors to perform a lot better, which is what we have seen at the end of 2020, at the beginning of 2021. For dividend aristocrats, shall we call them, i.e. companies that tend to pay higher dividends than the rest of the market, and usually more defensive areas of the market, to perform badly. However, when it comes to inflation actually coming through to the consumer, and to actually, for us, seeing that in supermarkets or in things that we buy, or even in, hopefully, wages, it is the pricing power that matters most, and which company can pass it on. And this is what we are focusing on. The companies with strong market leadership, with strong brands that have the ability to pass on that inflation, or where necessary to compensate that because of the cash available on their balance sheet. So the question, related to inflation is, and that we are considering, have we passed that inflection point for inflation and bond yields, and will the market leadership become entrenched, and what the trend that we have seen in the past couple of months, will it continue? The view is that there is a mean reversion play, and that's what we're seeing on the back of the value rally. However, going by historical examples, this mean reversion cycles tend to be rather short-lived, and this is our view. Time will tell how this plays out, and we are skeptical that we will see the conditions which sets the stage for a sustained outperformance of more economically sensitive areas of the market. So to zone in a little bit more on continental Europe, we believe that strong disinflationary forces remained as potent as ever, particularly for continental Europe, with areas like globalization, technological disruptions, demographics, and high levels of debt on the continent. So whilst the picture here is more green when it comes to what I've just said, and the disinflationary forces, it's very important to remember that European companies listed on European exchanges don't necessarily represent the European economy. As a market, Europe is large, international, and diverse, meaning it offers us plentiful of opportunities. So chasing, the market and positioning for a sustained value rally is not something that we can do and we intend to do. It's very difficult to predict with any level of accuracy. So what we aim to do is to look beyond economic and political noise and concentrate on the real life fundamentals of listed businesses that we invest in. Our guiding light, while staying fully invested, remains the tried and tested investment approach of focusing on companies with strong balance sheets which can grow dividends and cash flows sustainably. History has shown us that this characteristics is a marker of quality that can help us to identify those companies that are more likely to outperform the market over time. So unsurprisingly, similarly to some of the other investment teams that you've heard from today, the majority of our time is spent looking at individual businesses and figuring out whether they can grow and outperform the market. That said, we of course keep an eye on the wider market because we want to maintain a balanced portfolio with broadly neutral exposure across countries and sectors. It is a benchmark-aware approach, but we do stay fully invested through the cycle, as we believe that is what you as investors have entrusted us to do. To give, put things a little bit more to light as an example, Nestle is a company that many of you would be familiar with, is the largest holding in the portfolio and a long-standing investment in the trust. We've held this pretty much since the beginning of initiation of this trust more than 30 years ago. It's a steady Eddie that embodies the perfect type of company that we like to hold and that have in fact consistently outperformed the market and even the trust as a stock. Nestle has done better. And not to mention that it also pays its dividends in Swiss francs. It's, as the world's largest food business, it has a strong position in markets and operates in a number of sort of categories where it is both strong growth and also emotional engagement. One would argue even addictive behavior. Speaking for myself, things like coffee and chocolate that have kept me going for this pandemic. You know, and areas like pet care are big parts of Nestle's business. The outside CEO that they've appointed 3 years ago has a good track record of consistent and effective capital allocation. And the company, most importantly, has grown its dividend every year for the past 26 years. And from a valuation risk perspective, let's look at PE relative, it is not that different from the market. So it is holdings like Nestle, like ASML or SAP in the technology sector, like Roche in the healthcare sector, or L'Oreal and EssilorLuxottica, which you might be familiar with in the consumer sectors, that have helped us protect and preserve investor capital, particularly from our turbulent, failing markets. As evidenced sort of in this slide by the ability of this strategy to outperform in more than 70% of negative market performance months since 10 years. So in months when the market is going down, in particular, that's when we tend to outperform and protect. There will be some instances where that is unfortunately not the case. So in that context, and to put a little bit the portfolio in comparison to the index and the continental European market, you know, for us, valuations are still important. Today, the companies in the investment trust as a whole have almost the same valuation, and in this case, we're looking at dividend yield as a valuation metric, as the European market as a whole, whilst the trust contains a concentrated selection, today around 45 high-quality stocks, with much higher return on capital and higher sustainability of returns than the index. So we would argue that the right time to invest in any growth strategies or high quality strategies is when they have the same value or the same price as the index, but offer you a much higher quality and a much more sustainable level of returns and cash flow generation. As I'm sort of approaching the end of my presentation, many of the presenters today have quoted various investors. I will pick also an investor that I would like to quote, and it's actually a Fidelity long-standing investor, which is Peter Lynch, who has said, "Nobody can predict interest rates, the future direction of the economy, or the stock market, really. So dismiss all such forecasts and concentrate on what's actually happening in the companies in which we are invested on your behalf." Maybe we should add predictions about pandemic to that list as well, you know, in the shorter term. So as investors, we will remain focused on the companies in which we have invested, and in particular on their ability to continue to grow their dividends, to continue their cash generation trajectory. And for our part, you know, we remain confident that equities will rise in the long term. And as this year has shown, it pays to stay fully invested, or even modestly geared through stock market cycle. It's the time in the market, not timing the market, that matters in the long term, and that's what we're going to focus on. This is what I wanted to speak about to you today, and I'll end the presentation here.